Everyone thinks the stock market crash caused the depression. The crash was the symptom. The real killer was something the Federal Reserve did years before. October 1929, the New York Stock Exchange collapsed. 16 million shares traded in a single day. Fortunes evaporated, but the wreckage didn't start there. It started in the years prior, when the Federal Reserve made a choice about how much money to put into circulation. 1921 to 1929, the Federal Reserve kept interest rates low and expanded the money supply. Credit became cheap. Americans borrowed to buy stocks, to buy homes, to buy cars on installment plans. The economy roared, wages rose, stock prices tripled. Nobody, not the bankers, not the regulators, not the economists, fully grasped what would happen when that money stopped flowing. By 1928, the Fed began tightening. Interest rates rose. Money became scarce. Stock prices, which had climbed on borrowed money and optimism, suddenly had no fuel. The crash came fast. In 4 days, the market lost 20% of its value. What happened next revealed the true monetary failure. Banks failed, not because of the crash alone, but because the Federal Reserve did the opposite of what it should have done. As banks collapsed and people withdrew their savings in panic, the Fed tightened further. Money supply contracted by a third between 1929 and 1933. This was the mistake. A contracting money supply meant less cash chasing the same goods. Prices fell, wages fell, unemployment rose to 25%, farmers couldn't pay debts, factories closed. The depression deepened not because the crash happened, but because the central bank made deflation worse. Other central banks faced the same choice. The Bank of England, the Bundesbank, the Federal Reserve, all initially believed that letting the system correct itself was the right policy. All were wrong. The longer they waited, the deeper the hole became. By 1933, the Federal Reserve finally reversed course. President Roosevelt took the dollar off the gold standard, allowing the money supply to expand again. Recovery was slow, but the lesson was written in 10 years of economic devastation. Monetary policy doesn't just affect markets, it shapes survival itself. The Great Depression showed that central banks don't just manage economies, they can break them. How they respond to crisis, whether they tighten or expand, determines whether a downturn becomes a catastrophe. That understanding shaped every monetary policy decision that followed. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe for more episodes tracing how monetary decisions shaped history, new historical finance breakdowns every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research.